Energy prices moving higher to start the year. That has pushed the S&P Energy Index up nearly 8% just in the last couple of weeks. Joining us right now with more on the energy outlook for 2025 is Samantha Dart. She is Goldman Sachs co-head of Global Commodities Research. And Samantha, just looking at WTI prices yesterday, closed above $80 a barrel. That's the first time that's happened since August. What's pushing prices higher?
Yeah, I think we started with a winter that has been colder than average. So this is supporting distillate demand to a certain extent. We've had inventories drawing, particularly in the U.S., all through Q4. So, and then on top of that, of course, we had the announcements of the latest round of U.S. sanctions on Russian oil. So the market is repositioning towards these tighter risks in the balance. You know, we've been trading in this $70 to $85 per barrel Brent range, and we think we're going to stay in the range to be sure. But when we look at the risks to these prices in the near term, we do see these risks skewed to the upside, especially because of these risks to supply, sanctioned supply.
You know, the sanctioned supply has been a big issue, but we're also talking about this with the backdrop of a potential ceasefire in the Middle East. And you would think that that would at least offer some geopolitical de-risking that comes along with this. Is that not the case when you look to Ukraine and Russia and the sanctions that are taking place there?
I think because these geopolitical risks haven't really disrupted supply over the past couple of years, as we unwind them, we don't get that much relief price-wise, right? So you end up with this direct focus of the market on supply. And it's when we talk about sanctions and the potential of that really removing supply from the market, that gets the biggest reaction. The ceasefire, if it goes forward, does it change the supply and demand balance? It really doesn't. And especially in the context of a weaker Iran based on developments of the past several months, I think the risks that the market had been associating with Iran supply and this particular conflict hadn't been very high to begin with.
You know, the demand picture is also one that people watch so closely. There had been some concerns about the global economy. U.S. economy looks to be doing very well. And I think when you look at demand, I think what you wrote is that you're seeing some enormous demand coming, especially from some of the emerging markets, too.
Yeah, demand continues to be driven by emerging markets. You're absolutely right. We see just under 1 million barrels a day of growth next year. The thing is that we also see growth in supply close to those levels. On net, we have a small surplus expected for the next 12 months, which we think keeps oil on average in this range that we talked about. Our average price forecast for Brent for this year is $76 a barrel.
We're also talking all the time about AI and the huge demand for additional AI, the need that creates for new data centers to be built. How does that impact the longer-term demand push for energy?
The potential is enormous, right? So our equity research teams have done great work highlighting how just in the U.S., as an example, we could have a 20% increase in total power demand in the U.S. between 2023 and 2030. So it's not that much time, it's about 7 years for a pretty sizable increase in power demand. So when we look from a commodity standpoint, we think we're going to need all the fuels that we can get, all the technologies in terms of generation capacity, both renewables and especially natural gas.